When you think of Warren Buffett, what immediately comes to mind, for most of us, it's the iconic buy and hold forever guy, right? The sage of Omaha.
Yeah, that's the image. Almost legendary.
But what if that familiar image is just, one side of the coin? What if there's this much more dynamic, adaptable, even surprisingly nimble investor hiding in plain sight?
Exactly. What if he's done way more active trading, exploited a whole range of opportunities you might not even associate with him?
Okay, so that's what we're doing today. We're kind of shattering that typical narrative. Welcome to this deep dive.
We're exploring how Buffett really applied his core idea, that margin of safety, in, well, incredibly diverse and often unexpected ways. Our guide here is James Altucher's book, Trade Like Warren Buffett.
Right. And our mission for you, the listener, is to unpack these lesser-known, sometimes pretty aggressive, trading tactics he used over the decades.
We want to give you a really comprehensive, nuanced picture that goes way beyond the headlines.
Yeah, reveal some surprising facts, maybe some aha moments that show just how versatile he truly is as a capital allocator.
Okay, let's get into it.
We've sort of hinted at it, but let's really dig into this core idea, the margin of safety. We all kind of know the Benjamin Graham definition, right? Buying something for way less than it's worth.
Sure, the classic value investing idea.
But how did Buffett take that fundamental concept and just stretch it, make it something much bigger than simple value investing?
Well, what's fascinating, and Buffett herself said this, is that the whole distinction between value and growth investing is nonsense in his view.
Really? Nonsense.
Yeah. For him, margin of safety isn't just about buying cheap stocks. It's about having multiple, often totally uncorrelated reasons why an investment probably won't lose money.
Okay, multiple reasons, like safety nets.
Exactly. Think of it like having several back doors, just in case your main plan, your main thesis, doesn't quite work out.
So the obvious question then is, how did he apply that outside of just buying good companies and holding them forever?
That's the key question.
It's a really powerful shift in how you think about it.
Yeah.
But, I mean, he's known for patience, right? Long hold. How does this backdoor idea fit with that? Doesn't it sound more short-term, maybe even tactical?
It absolutely does, and that's where the popular image kind of misses the full picture. Remember, before he was the big insurance guy we know now, Buffett actually ran a hedge fund. This was between, 1957 and 1969.
A hedge fund, okay.
And here's the real kicker. During that time, in some years, over half his profits came from things he called workouts.
Workouts, what were those exactly?
Well, connecting it back, these workouts were things like merger arbitrage, company spin-offs, opportunities in distressed debt, other, special situations.
Ah, okay.
The common thread, buying something cheaper than it was worth, sure, but often for a pretty short holding period. Definitely not forever.
Right, so predictability was key.
Yes, that predictability, even if the gross profits on each deal weren't huge, led to, in his words, quite decent annual rates of return.
And, this focus on predictable, maybe shorter-term stuff, it actually explains his big shift later on, doesn't it?
How so?
Well, moving from the hedge fund to the insurance business, which really ramped up in the 70s and 80s, that was also about optimizing profit, right?
Absolutely. In the hedge fund, he took, 25% of the profits?
Yeah. But with insurance, he gets to keep 100% of the float.
Exactly. Those premiums paid up front that you only pay out later, ideally, you get that float at zero cost. For a master capital allocator, it's just genius. Gives him that capital to deploy.
Okay, so within those workouts, let's zero in on one. Merger arbitrage. Again, sounds active, transactional. Why would Buffett, Mr. Patience, get involved? What is it?
So merger arb is basically exploiting the price difference, the spread, that appears when one company announces it's going to buy another.
Okay.
You buy the target company's shares, expecting them to go up to the deal price when it closes. The beauty or the margin of safety here is that your main risk isn't the overall market going up or down.
It's the deal itself.
Right. It's whether something upsets the apple cart, as Buffett put it. That could be antitrust problems, shareholders voting no, maybe a negative tax ruling.
So the safety comes from analyzing the deal's likelihood of closing.
Precisely. Despite the short-term nature. Let's look at Arcata paper in 1981. This was pretty complex. A leveraged buyout, KKR was involved.
Right.
And there was this big speculative litigation claim hanging over it, something about redwood timber taken by the government. Buffett did his homework, checked out KKR, looked at Arcata's other options.
Due diligence.
Always. He started buying around $33.50. The deal hit snags, delays, even price changes, but it eventually closed at 37.20 cents.
Oh, decent return.
Yeah, about 15% annualized before the really big picker. Later on, he got this huge extra payment from that Redwood claim, an additional $29.48 per share.
Wow, so the genius wasn't just the spread.
No, it was his obsessive focus on the deal completion risk and understanding patiently that these short-term things often take longer. But if you're right, the payoff is there.
Okay, another example.
Sure, Texas National Petroleum, back in '63. Much more straightforward. Involved debentures, stock, warrants after a public announcement. Buffett famously just ignored the rumors. He noted, quote, risk of stockholder approval was nil, no antitrust issues, a tax ruling delayed things, stretched the holding period.
Left the return.
Ended up being about 21% annualized. And his comment on this stuff is classic. Deals take longer than originally projected, but payouts tend to average a little better. Patience and diligence again.
Incredible. But look, that was then. He said in '99, arbitrage could still yield 50% annually. Is that, like, even remotely possible today? We actually talked to John Arrico from the Arbitrage Fund about this.
Right. And Arrico makes it clear. Today's spreads are tight, really tight. So the value now isn't just spotting a spread. It's about deeply understanding the whole transaction, maybe making directional bets, using sophisticated hedging.
So way more complex.
Way more. He stressed the need for intense due diligence, scrutinizing everything.
Yeah.
Earnings consistency, accounting transparency, management quality, balance sheets, peer valuations, competitive position, the works.
So modern ARB is less about a simple price gap and more about active management and anticipating moves.
Exactly. You're managing every possible downside, using sophisticated techniques to keep that margin of safety.
Okay, so if spreads are so tight, does that mean these opportunities are just gone for, the average person?
Yeah.
Or is the barrier just way higher?
That's a really good question. Orico gave some examples of the risks involved today, like the Pfizer-Esperion deal. Understanding the strategic value for Pfizer was critical.
Why they needed the deal.
Right, or First Data buying Concord, you had regulatory risks, potential business disruption if customers didn't renew contracts. These were huge factors.
So how do they manage that risk now?
Well, his team does things like wait for short sellers, lock up shares to short, use options to hedge when things get volatile. They like quicker deals, higher quality companies for the big bets.
Makes sense.
Or they might go big if the target's trading below book value. But interestingly, he said they avoid deals if they lack confidence in the buyer, the financing, or if the target's business is just, fundamentally broken.
So yeah, it sounds like the barrier is definitely higher today for an individual.
For sure.
Okay, so that covers direct takeovers. But what about those situations where there isn't a merger? Just a weird price difference between two related things. Relative value arbitrage. How's that work?
Yeah, this is about exploiting just irrational pricing in the market. Buffett's mentor, Benjamin Graham, found one back in 1915 with Guggenheim Exploration. It was a holding company.
Yeah.
And its shares were trading for less than the actual value of the stuff it held inside.
Seems obvious.
Or DuPont in the 1920s. Its shares traded for less than the value of just its GM stock holdings. It basically implied all of DuPont's other massive profitable businesses were worth zero.
Okay, but can that really happen now in the internet age?
Yeah.
Information moves so fast, you'd think the market corrects that instantly.
You'd think, but yes, absolutely. Look at the Palem spinoff from 3Com in 2000. This was peak .com craziness.
I remember that.
3Com shares were trading at $81, but just their stake in Palem, which they were spinning off, was valued by the market at $152 per 3Com share.
Get out.
Seriously. And on top of that, 3Com had $10 a share in cash and a profitable business itself. It implied like a $60 plus negative value for everything else 3Com did. Pure market irrationality.
Wow. So even with instant info, herd mentality takes over.
It absolutely can. These mispricings still happen.
But there's a catch, right? Isn't this risky?
Oh yeah, there's a dark side. Leverage and illiquidity can kill you. There was the Ifuku Fund in Japan, wiped out in 2003 when a spread widened against them.
Not LTCM.
Right, long-term capital management, the famous one, the Royal Dutch Shell Trade. Essentially the same company, 60-40 split, but the shares traded with this weird widening gap. Caused massive losses for LTCM before it finally converged. Shows the danger, even for Nobel Prize winners.
Okay, so he's definitely opportunistic. But what about when companies are really up against the wall, like desperate for cash? Did Buffett step into those situations?
Absolutely. That's where PIPEs come in private investments in public equities.
PIPEs.
These are direct sales of shares or often debt straight to private investors like Buffett. It's often used when, the normal ways of raising capital are shut off.
Because the company's in trouble.
Usually. It avoids the immediate dilution of a big secondary offering, high fees, long SEC filings. It's quicker, more direct for a company in a pinch.
And Buffett saw opportunity there.
Big time. He often played the white knight. Look at Gillette in 1989. Bic was breathing down their neck. Sales were weak. Debt was up.
Right.
Buffett bought convertible preferred stock, paid an 8.75% coupon. He basically got, as Altucher puts it, a free ticket to watch the show from the safety of a bond, knowing he could convert later for a potentially enormous profit.
Smart structure.
It's very. Or Salomon Brothers, the investment bank, back in '87. Troubled company, super sensitive to market swings. Buffett steps in again with convertible preferred stock, paying a nice 9% dividend.
Another safety net.
Yep. He converted parts as the stock went up. He later said about that investment famously, "I'd say we hit a scratch single, but not before the count got to 0 and 2. It really shows his focus on the transaction structure as a source of safety. Get paid while you wait.
Okay. Any more recent examples?
Level 3 Communications, 2002. This was a telecom bubble casualty, stock down over 95%, just crushed.
Ouch.
Buffett and others bought $500 million in convertible preferreds. Stock was at $2.89. The preferred paid 9%, convertible at $3.41. But here's the kicker.
The back door.
The back door. The company still had $1.5 billion in cash and this huge 20,000-mile network they could sell off if things went totally south.
Asset protection.
Right. The day Buffett's investment was announced, the stock jumped 50%. He made 95% on his money in just 16 months. And one more quick one. Williams Companies, also 2002. Remember Enronitis? The whole energy sector was toxic.
Yeah, scary time.
Williams was struggling to get loans. Buffett's Mid-American Pipeline subsidiary stepped in with financing. Less than a year later, Williams paid it back. Buffett made a nice profit.
These are incredible stories. But they sound risky too, dealing with companies in distress. Did these PE deals ever look like they might go bad? Or was his margin of safety just rock solid?
That's a really important question. It wasn't zero risk, nothing ever is. But the margin of safety was incredibly well structured to minimize that downside.
So it's about the deal as much as the company.
Exactly. The big lesson from these PEs isn't just about picking the right distressed company. It's about the structure of the investment itself. Buffett isn't just looking at the business, he's building the deal to have those multiple back doors.
Investing higher up at the capital structures.
Often, yeah. More senior debt, preferred stock, especially in shaky industries. It really teaches you that how you invest the structure, the downside protection, can be just as important, maybe more so, than what you invest in, particularly when things look dicey.
That's a really key insight.
Yeah.
Okay, sticking with risk. Did he just stick to known companies? Or did he ever dip into really risky stuff, like, say, junk bonds?
He did. I mean, the market calls them junk for a reason, right? High risk of default.
Generally, yeah.
But Buffett saw pockets of opportunity. He bought bonds from the Washington Public Power Supply System, WPPSS, or whoops, as they were known.
Right.
They yielded something like 16.3% after tax. He looked at them not just as bonds, but almost like an operating business with high, predictable earning streams backing them.
Interesting perspective.
But even then, he was cautious about long-term bonds because of inflation risk. That was a consistent theme for him for decades. Shows his long-term thinking even in these higher yield plays.
Okay, now for maybe the weirdest one. Life insurance policies. That sounds kind of dark. How did he get into that, and where's the margin of safety?
Yeah, it sounds a bit morbid on the surface. Through Gen Re Securities, part of Berkshire, they provided financing up to $400 million to a firm that was buying life insurance policies from seniors, usually people over 65 who'd had a decline in health.
Okay. How does that work?
Well, the value of the policy is basically figured out by discounting the death benefit back to the present, using a risk-free rate over the person's expected remaining lifespan.
So the edge is knowing lifespan's better.
Pretty much. The margin of safety comes from having better actuarial models, better life expectancy data, and crucially diversifying across a lot of policies, so no single policy outcome blows you up.
Diversification is key.
And interestingly, it actually creates a secondary market, so policyholders who might otherwise let their policies lapse could get some cash value instead, so arguably beneficial for them too.
A classic Buffett move, finding value where others might just see complexity or feel uncomfortable. Now, it's one thing for Berkshire, this massive company, to do these huge complex deals. But did Buffett apply these same kinds of opportunistic, maybe even tactical principles to his personal investments.
Oh, absolutely. And looking at his personal stuff really reveals that more tactical side. Think about the late 1990s peak internet boom.
Okay.
REITs, real estate investment trusts, were totally out of favor. People thought online shopping meant malls were dead, right?
Yeah, that was the thinking.
Buffett started buying REITs, not because he had some grand vision for all real estate, but he was buying specific companies at huge discounts or for their liquidation value.
Okay, like what?
Laser Mortgage in 2000, a mortgage REIT, got hammered by interest rate spikes, defaults, stock fell way below book value. Buffett bought in around $4.
Right.
The company ended up liquidating, paid out over $4 per share eventually. Nice little profit from buying below tangible value.
Okay, what else?
JDN Realty, also 2000, shopping center REIT. Stock crashed over 50%. Why? Executive pay scandal, earnings restatements, messy.
But the buildings were still there.
Exactly. The underlying real estate value didn't change. Tenants like Walmart were still paying rent. Buffett bought below book value, and later the company merged at $13 a share.
Nice. Any others?
Tanger Factory Outlet Centers, 1999, trading at a 27% discount to its net asset value, paying a 12% dividend. He bought 5%, then upped it to over 13%. And MGI Properties in 98, a company liquidating its assets, estimated value $33, trading at $20. Pure arbitrage play for him.
So these were definitely tactical, shorter-term value plays, always looking for that discounted dollar, whatever the wrapper.
Better batter.
Okay, another niche strategy.
Yeah.
Closed-end funds. This sounds a bit obscure, too. What is a closed-end fund, and how did he find safety there? Seems different from his usual operating businesses.
Yeah, they're a bit different. Unlike regular mutual funds, closed-end funds have a fixed number of shares, and they trade on an exchange like a stock.
Okay.
And often, they trade at a pretty big discount to their net asset value, the actual value of the stuff inside the fund. Could be due to built-in tax liabilities, or maybe the fund holds illiquid assets.
So you can buy $1's worth of assets for less than $1.
Sometimes significantly less. Buffett saw huge opportunities when those discounts got extreme, basically buying $1 for, say, 50 or 60 cents.
Any examples?
Baker Fentress in 1999, an old closed-end fund held valuable real estate. Trading at a 26% discount, it announced a partial liquidation. Buffett jumped in, bought over 5%.
Makes sense.
Another famous one, him and Charlie Munger bought into this through blue chip stamps back in the 70s. It was called the Fund of Letters, or Source Capital. It had been a hot go-go fund, fell out of favor, traded at a 50% discount to its NAV.
50%.
Yeah. And Munger, with his friend Rick Guerin, did something similar in the late 60s with the New America Fund. It was a public VC fund. They accumulated shares when it was cheap, eventually got control and liquidated it, took the shares from like $3.75 up to $100.
Wow. So again, it's about finding value when the market just throws things out.
Exactly. When the market throws the baby out with the bathwater, disciplined investors can find these deep discounts with a built-in margin of safety, turning that market irrationality into profit.
Okay, shifting gears a bit. Buffett famously says he doesn't market time,
Yeah.
calls short-term forecasts poison.
Right.
But is that entirely true? How does he really view big market moves or even disasters? And what does he do? Seems like there might be a subtle difference between forecasting and reacting.
That's a really good point, a great observation, because while he absolutely rails against short-term forecasting, he has made what certainly look like market calls at least 6 times, according to Altucher.
Like what?
Well, closing his hedge fund in 1969, right before the market went basically nowhere for a decade. That looks pretty timely. Or in 1992, stating flat out that stock rewards over the next decade would be significantly smaller. And that famous comment in 1974, feeling like he was oversexed in a harem.
Right, meaning stocks were incredibly cheap.
Exactly. It clearly showed his view that the market was deeply undervalued then. So maybe they weren't precise predictions, but they were definitely observations about extreme value, or lack thereof, in the overall market.
Interesting distinction. What about simple indicators like PE ratios? Does he use those for market timing?
He says PE ratios, price to earnings, are completely useless. He's often bought companies when their earnings were falling and PEs were shooting up.
Counterintuitive.
Totally. And simulations apparently show that a simple strategy like buy when market PE is below 10, sell when it's above 20? Well, since 1900, that didn't actually beat just buying and holding.
So PE alone isn't the answer. What about the Fed model, comparing stock yield to bond yields?
He seems to have used that thinking, at least implicitly. Back in 1974, for instance, stock earnings yields, the inverse of PE, were way higher than bond yields. That smelled like a buy signal to him.
Relative value again.
Exactly. While the model itself might have shifted over time, that relative relationship between stock yields and bond yields can still flag extremes in sentiment, which seems to be what Buffett pays attention to. Not timing, but recognizing extreme opportunity or risk.
Okay, let's talk about disasters. Markets obviously freak out after major shocks.
Yeah.
What's Buffett's big lesson from those moments of panic?
Yeah.
And how does he, capitalize?
His quote after 9/11 is probably the most famous illustration of his thinking. He said, basically, if you believed in the long-term growth of the U.S. economy on September 10th, you should still believe on September 12th.
Don't panic. Stay the course.
Pretty much. And if you look back at history, World War II, Pearl Harbor, Cuban Missile Crisis, Gulf War, the 93 WTC bombing, 9/11 itself,
Yeah.
in every case, there was initial panic. The S&P 500 definitely dipped. Like after 9/11, it fell from around 1092 down to 944. But consistently, the market absorbed the shock and moved past the event, usually within a few months.
So the dips are temporary.
Historically, yes. And it's precisely in those moments, when fear is rampant and everyone else is selling, that investors like Buffett often make their best buys. Assets get temporarily mispriced, deeply undervalued. It comes back to his conviction in the long-term system.
Buying when there's blood in the streets, as they say.
If you have the cash and the courage, yes.
Now, Buffett's influence is obviously huge. Let's talk about some other investors who use his style, maybe adapting him, and perhaps touch on why he generates such fascination, maybe even, as Altucher calls it, jealousy.
Yeah, it's interesting to see how adaptable his core principles are. Take Zachary Abraham, a hedge fund manager mentioned in the book.
Okay, how does he apply it?
He looks for smaller, high-quality companies. Things like single-digit price-to-free cash flow, strong balance sheets, good brands, solid niches, management that cares about shareholders.
Sounds Buffett-like.
Very. He thinks these get cheap just because they're kind of boring. They don't have big index funds automatically buying them.
Avoiding the spotlight?
Right. And he argues a portfolio of these isn't necessarily a value trap if you have enlightened management, because that management will do smart things, make good acquisitions, buy back stock, pay dividends.
Got it. Any examples?
He mentioned ValueClick, an internet ad company. Back in 2002, he bought it for $2.30 a share when it had $3 a share in cash. He saw its potential as the ad market recovered.
Great buy.
Yeah, he sold at $5, doubled his money in 9 months. But then he laments the stock rocketed onto $12. Classic value investors lament, right? Selling too early to lock in that margin of safety.
I know that feeling.
Does he do anything else?
He also shorts stocks, what he calls the cream of the crop.
Love that name.
Overvalued stocks, terrible businesses, hideous management, burning cash, often targets them after they do a secondary offering, figuring new investors won't want immediate pain.
Smart timing.
He gave Commerce One Software as an example, shorted at $3, covered at 60 cents. He looks for like a 30% drop in 6-8 weeks on shorts, emphasizing that the qualitative review, the story, is crucial.
Okay, who else applies these ideas? Monish Pabray, another fund manager. He doesn't even like the term hedge fund, prefers private mutual fund or private investment partnership. No hedging, no leverage, no derivatives.
Interesting. What's his angle?
Well, he had incredible returns, like 60% annually from 95 to 2000. He argues that while buying great businesses is good, compounding has its limits, maybe 20% return on equity you can redeploy endlessly. But special situations, buying that dollar for 50 cents and selling it for a dollar, that can give you much higher returns over shorter periods, like 100% in a year or 26% compounded over 3 years. It can often beat buy and hold short term.
So more focus on the special situations.
Yeah, his philosophy is let the game come to you, look for anomalies, extreme fear, big clouds hanging over companies that he can maybe see through to the underlying value.
Got an example.
Stewart Enterprises, funeral services company, ton of debt, a big note coming due. Stock crashed from $28 down to $2.
Wow, near death.
Literally. Pabray bought in, believing they could sell off some of their 1,000-plus funeral homes to sort out the debt, which they eventually announced they would. Stock shot up after he invested.
This call. How does he handle risk?
He aims for about 10 uncorrelated bets across different industries, says he's not willing to put 30% in one thing like Buffett sometimes did, because there are too many big macro factors you just can't analyze today.
Diversifying the special situations. Makes sense.
Yeah.
It's really cool seeing how others adapt his core ideas. What about someone really close to him, like his bridge partner, Bill Gates? Does Buffett's thinking show up in how Gates manages his own massive wealth?
Oh, absolutely. Gates's personal portfolio, managed by Michael Larson through Cascade Investments, it definitely shows the Buffett
How
influence.
so?
Well, it's huge, over $5 billion, but it's diversified without being overly diversified, only about 18 significant positions.
Concentrated, relatively speaking.
Right. And the holdings, airlines, energy, particularly utilities like Otter Tail, PNM, Vista Hotels, biotech, steel, a mix of understandable businesses.
And Gates even gets involved.
Yeah, he even engages in some shareholder activism, like fighting the Schnitzer family for independent directors at Schnitzer Steel. That's a classic move straight out of Buffett's early playbook.
Huh. It's amazing. It really shows the power of Buffett's thinking, influencing even the world's wealthiest.
Definitely.
Okay, so given all this success, all this influence, it makes sense he attracts admiration, but also, as Altucher puts it, sometimes jealousy. What are some common criticisms leveled against Buffett? And how do they maybe reflect his unique approach?
Well, one common one is that he doesn't invest in new technology, right? He missed the boat on tech giants.
Yeah, you hear that a lot.
But his counter, and Altucher points this out, is that historically most revolutionary technologies, think railroads, early computers, cars, they spurred the economy, sure, but they weren't necessarily great investments for most players. Only a few winners survive and thrive long term.
So his focus is on investment success, not just spotting the next big thing.
Exactly. It's about certainty and understanding, staying within his circle of competence. That's a fair defense, you could say.
But couldn't you argue that in today's world, ignoring emerging tech entirely might become a blind spot eventually? What's the counter to that?
Well, the counter-argument for Buffett would simply be his unwavering focus on that certainty and understanding. If a technology is too new, too unproven, or moves too fast for him to really get his head around its long-term competitive advantages and intrinsic value,
It's outside the circle.
it's outside the circle. He'd rather miss a potential huge win than risk a big loss on something he doesn't truly grasp. It's discipline.
Yeah. Okay. Any other criticisms?
Another one mentioned was his prediction, made from an actuarial standpoint, of a near-certain nuclear attack on U.S. soil within 50 years.
Whoa.
From his perspective, running a massive insurance operation, it's just a mathematical probability you have to consider and price for. It really underscores that pragmatic, maybe even cold-eyed, risk-averse mindset he applies, even on a global scale.
Okay, wow. We have covered a ton of ground here.
We really have.
We've definitely taken a deep dive. And hopefully you, the listener, have seen that Warren Buffett is just so much more than the simple buy and hold caricature.
Yeah, he's a true master of capital allocation, relentlessly hunting for that margin of safety, but through this incredibly diverse toolkit.
Right, from complex arbitrage, opportunistic PE deals, buying distressed assets.
Even digging into weird niches like secondary life insurance policies. He's flexible, he's shrewd, he's deeply analytical, and yeah, he's a trader when the right opportunity shows up.
So what's the big takeaway for you listening?
I think it's not just about copying his tactics, because some are hard to replicate now. It's about adopting the mindset.
Always asking.
Always asking, what's the real value here? What are the real risks? And critically, what are my back doors? What happens if my main idea doesn't work out?
That adaptable quest for a margin of safety, whatever form it takes, that seems like the real enduring lesson.
I think so.
Okay, final thought to leave you with. If Buffett himself said he could guarantee, 50% returns on $1 million just by exploiting these kinds of market anomalies, does that mean the biggest challenge for an individual investor isn't really finding opportunities, but having the sheer patience, discipline to just wait for those fat pitches? Makes you wonder, doesn't it?
Yeah.